$1 trillion. That is the revenue hole on page 4. AI needs to make $1 trillion just to break even.
And that single number just perfectly captures the tension, doesn't it? It runs through this entire JPM 2026 long-term capital market assumptions report. It's the cost of admission to the future, and, well, it's a staggering cost.
It is, and that's what we're focusing on today, that core tension. You have this massive front-loaded capital expenditure into infrastructure, into hardware, what I call physical AI, and you're weighing it against the sustainability of corporate valuations, which, I mean, let's be honest, are almost entirely built on future software potential.
Exactly. So the central question for anyone reading this is, is this multi-trillion-dollar bet on data centers, on chips, on power infrastructure, is it a reliable engine for long-term growth? Or are we just looking at a highly concentrated, unsustainable software bubble that's going to normalize long before any real widespread user revenue shows up?
Well, I'm taking the position that the accelerating investment into capacity, the fact that companies are basically forced to spend this money right now, that confirms the long-term, durable value of the AI trend. It's a robust secular tailwind, a tangible silver lining against all the geopolitical and macro risk out there.
And I'm going to argue that while that foundation is being poured, the valuations sitting on top of it are masking critical execution risk. Margin risk. I think the current market structure points to an inevitable and probably painful normalization where value shifts away from these initial tech leaders and toward the actual users in other sectors.
See, for me, the sheer necessity to invest is the story, and that necessity gives me confidence in the long-term outlook. AI adoption is, it's by far the strongest force driving corporate CapEx today. And it's accelerating because of, demographic reality. We have a less abundant labor supply, aging populations, tighter migration policies. So companies are simply compelled to invest in productivity just to stand still.
But you're focusing on the physical side. That's CapEx chasing a financial hypothesis. It's chasing the expectation of future revenue.
But the conviction is there. You can see it in the assets being targeted. We're seeing higher return forecasts for these, tangible, durable assets. Global infrastructure is projected at 6.5%, up from 6.3%. Private equity, which is now, as we know, heavily exposed to tech, still has a 10.2% composite return forecast. The report itself validates this, calling out data centers driven by AI load growth that, and I'm quoting here, outpaces the investment cycle in power grid. And this is key. This physical investment, it validates the core economic optimism in the report. They've modestly raised the total factor productivity or TFP growth assumption for the US to 1%. Now, for anyone who doesn't know, TFP is basically a measure of efficiency. So raising that number implies a profound structural belief that these AI productivity gains will materialize. That 1% is real growth, not just, financial multiple expansion.
I see the necessity, and I see why that 1% TFP number is compelling. But let me introduce the fragility of the multiple expansion that's currently funding this whole infrastructure boom. That CapEx is being funded by market assumptions that are, they're dangerously rich. The report calls it a persistent headwind. Just look at the S&P 500. The trailing 12-month PE ratio is up to 24.9. These assets are expensive. And the report itself admits this is a structural problem. It states, and I think this is critical, that earnings from firms that provide the technologies, so the current leaders, will ultimately normalize later on, while the gains will accrue to the users.
But assets are expensive for a reason: resilient profits and the promise of that productivity premium.
Resilient for now, but the richness points to systemic fragility. If the report itself predicts that the supersized margins of the Magnificent Seven are structurally unsustainable, why are we justifying a 24.9 PE? We're buying a growth story that hasn't materialized yet in broad revenue streams, and you can see it in the concentration. The top 10 companies are a staggering 40% of the market cap. That is masking so much downside risk.
That is a fair point on concentration, I'll give you that. But I would frame the normalization a little differently. JPM is still holding a solid 6.7% U.S. equity forecast long term. Now, if they really thought a collapse was coming, that forecast would be way lower. The confidence comes from the U.S. being the undisputed leader in tech R&D. That supports resilient profits, and it justifies the premium, even with the anticipated deployment shift.
I'm sorry, I just don't buy that. I don't see how the math works for a 6.7% return starting from a 25 PE, especially when the report's own structural expectation is that the margins of the providers will normalize, which means fall, probably significantly. That 33% valuation premium the US has over the rest of the world starts to look less like a premium and more like a massive risk exposure.
It's a transition, not a collapse. The U.S. lead is sustained because of this accelerated capital deepening. This isn't just a numbers game on a screen. It's a real commitment to capacity that ensures sales growth. Exhibit 6 in the report, it shows AI benefits are already starting to show up in sales and margins. The transition will diffuse the concentration over time. It won't trigger some kind of immediate collapse. We're building the rails. That validates the long-term earnings.
Okay, let's talk about the downside risk of financing that physical build-out, because that is where this gets really fragile. We agree the infrastructure boom is tangible. Data centers, power, copper, fine. But the financing mechanism, specifically private credit, introduces a huge systemic risk. Technology now makes up nearly 25% of direct lending portfolios. That is a massive, concentrated bet.
And private equity exposure is even higher, 36%. If anything, that just confirms the high conviction sophisticated investors have in the sector's long-term viability. They believe in the recovery value of the assets being created.
See, I take issue with that assumption. That's the central contention right there, the recovery value. Because while PE has conviction, many of these tech businesses are asset light. The software layer, the very thing you say is driving the valuation, it creates huge questions around what you recover in a default. If a company fails, it's a lot harder to liquidate intellectual property and software licenses than it is to sell off, say, manufacturing equipment. So you have a physical boom being funded by financial assets with very questionable recovery values.
But the financing isn't purely resting on soft assets. The core investment, the physical infrastructure itself, that offers tremendous stability. The report even noted that infrastructure as a sector didn't reprice as heavily as real estate did when rates went up. That suggests it's stable, it has pricing power. The fundamental necessity of power and connectivity secures the hard asset side, and that provides real collateral against that private credit exposure.
That's a neat trick, arguing the physical collateral offsets the financial engineering risk. But what about the dry powder issue? You've got all this committed, uninvested capital and private credit just sitting there, and when managers feel pressure to deploy that capital to earn fees, what happens? Underwriting standards go down. And this isn't theoretical, the report itself reflects it. They raised the default loss assumption for direct lending from 2% up to 2.5%. That 0.5% increase is a material signal of concern. So you have this cheap capital funding highly valued asset-light tech ventures with weakening standards. That's the very definition of capital misallocation risk. And it's all fueled by the software hype.
Look, misallocation is always a concern, but private investors are incentivized to manage that risk. And the sheer scale of global capital deepening, it suggests this investment is necessary regardless of short-term volatility. We're facing elevated inflation, geopolitical uncertainty. All of this requires firms to invest aggressively in productivity to protect their margins.
Fragile. JPM literally increased the weighting they give to periods of high inflation and rate uncertainty to 12.5% in their assumptions. That's a huge institutional signal of caution. High inflation volatility means the cost of capital stays high, which makes a 25 PE ratio incredibly vulnerable. And on top of that, you have this tension between tech advancement and, frankly, policy regression. Economic nationalism, trade friction, the report calls it a source of economic volatility that may push up the cost of capital. So we're spending trillions on physical AI just as borrowing costs are forecast to stay high and volatility is set to increase.
But that volatility is precisely why the physical investment is so crucial. Fiscal activism, CapEx incentives like we've seen in the US, they are a powerful offset. This focus leads directly to capital deepening, investing in better infrastructure, which supports long-term productivity gains. And those gains should eventually help offset inflation, allowing rates to ease over the forecast horizon. And this dynamic, it's already reflected in the market assumptions. The forecast for the 10-year U.S. Treasury is up to 4.6%,
And critically, the stock-bond frontier is flattening.
Okay, let's unpack that for a second. The flattening of the stock-bond frontier. It means bonds are giving you less and less diversification against stocks than they used to. If inflation is high and volatile, stocks and bonds tend to move together. So that volatility isn't generating the portfolio buffer people think it is. It just adds more risk to these highly concentrated, expensive equity portfolios.
It adds complexity, sure, but high volatility also creates opportunity for skilled active managers, which, as VCs is where we operate, to exploit market inefficiencies. We're betting that the long-term CapEx imperative translates into superior sustained corporate sales growth, and that growth will eventually make that 25 PE ratio look reasonable in hindsight.
The problem is the timeline. The vulnerability is now. Investors are betting on distant productivity benefits while facing immediate headwinds from margin normalization and a volatile cost of capital. Until that multi-trillion-dollar CapEx spend translates into widespread, measurable productivity across all the user sectors, not just in the revenue of a few chip manufacturers, the financial market is fundamentally vulnerable to a sharp correction.
We remain confident in the AI investment channel. The scale of public and private commitment here, it's not temporary. It's a powerful secular trend driving higher potential growth, despite the policy headwinds. The investment has secured the physical foundation for the next decade.
And my concern remains squarely on the financial valuation that's resting on that foundation. We're overpaying for software potential today. Until the market completes that structural shift from high-margin adoption profits to widespread deployment revenue, where new revenue accrues broadly to users, not just providers, the whole system is fragile. The market has to reckon with that high PE ratio and the material risks of misallocation in private credit.
The infrastructure is being built, the chips are being bought.
But until the software makes money,
We are walking on thin ice.